What if the AI compute shortage is already starting to crack? For 2 years, investors paid premium prices for one belief: AI compute would stay scarce. More chips, more data centers, more GPUs, more power, more cloud capacity. The whole AI trade was built on the idea that there would never be enough compute. But now, Meta may be preparing to sell excess AI capacity. That changes the question. This may not be just another growth story. It may be the first sign that the AI infrastructure trade is moving from scarcity to oversupply. And if that is true, some AI stocks may be priced for the wrong future. This video is not about whether Meta is a good or bad stock. It is about a bigger shift in the AI trade. The market may be moving from a scarcity story to a return on investment story. And that shift matters. This video is for education only. It is not financial advice. Let's break it down in simple English. Here's what happened. Meta is reportedly developing a cloud infrastructure business, sometimes described as Meta Compute. The idea is simple. Meta may rent out access to AI computing power and hosted AI models on its own infrastructure. One version would look like a model hosting service. Developers could access Meta's AI models without building the infrastructure themselves. Another version would be more direct, renting out raw AI compute, similar to what AI cloud companies like CoreWeave and Nebius offer. At first, that sounds like a smart move. Meta has been spending aggressively on AI. Data centers are expensive. GPUs are expensive. Power is expensive. AI talent is expensive. And investors have been asking one basic question: when will all this spending turn into real money? So if Meta can monetize unused capacity, that helps the bull case. It turns AI infrastructure from a pure cost into a possible business. But markets are never that simple. The same news can tell two very different stories. The bullish story is, Meta found a way to monetize AI spending. The bearish story is, maybe the hyperscalers built more capacity than they currently need. And that second story is what scared parts of the AI infrastructure market. To understand why this matters, you need to understand the original AI bull case. For the last 2 years, AI compute was treated almost like digital oil. If you controlled chips, data centers, cloud capacity, networking, or power, you controlled the bottleneck, and bottlenecks are valuable. That is why NVIDIA became the center of the AI trade. That is why cloud giants kept raising capital spending. That is why data center operators, memory companies, networking firms, power providers, and AI cloud platforms became part of the same story. Investors believed demand for AI compute was growing faster than supply. And when something is scarce, pricing power goes up, customers wait in line, margins stay strong, and investors are willing to pay premium valuations. But scarcity only works if the shortage continues. If supply catches up too quickly, the story changes. Suddenly, investors stop asking, who has the most compute? And they start asking, who can earn the best return on that compute? That is a much harder question, because owning expensive infrastructure is powerful when demand is tight, but it becomes risky when everyone is building at the same time. The market reaction showed exactly how sensitive the AI trade has become. Meta shares jumped on the news. And that makes sense. Wall Street liked the idea that Meta could turn a massive AI cost center into a new revenue stream. Less waste, more revenue, better return on investment. That is what Meta investors wanted to hear. Some reports showed Meta rising close to 10% after the news. But while Meta rallied, parts of the AI infrastructure trade sold off. CoreWeave, one of the most visible AI neocloud companies, dropped sharply. Nebius also came under pressure. Some reports showed CoreWeave and Nebius falling by double digits after the Meta cloud news. CoreWeave later fell again, after already suffering a much larger decline the previous day. And the reason is simple. If one of the biggest buyers of AI compute starts becoming a seller of AI compute, the market has to rethink the entire competition story. Meta is not just another cloud startup. Meta is one of the biggest AI infrastructure spenders in the world. And if a company like that enters the market with spare capacity, it can change pricing, supply, and investor expectations. This is the key point. Meta investors saw a cash cow. AI infrastructure investors saw a price war. Same news, opposite reactions. And that is where the complacency ends. This story did not just move one stock. It challenged the entire idea that AI compute would stay scarce forever. So does this mean AI infrastructure is already overbuilt? Not necessarily. That would be too simple. There are still real shortages in parts of the AI supply chain. Advanced GPUs are still important. Power is still a constraint. High bandwidth memory still matters. Networking is still a bottleneck. And large-scale AI training and inference still require enormous compute. So no, this does not mean the AI infrastructure cycle is dead, but it does suggest something more subtle. The shortage may not be evenly distributed. Some compute may still be extremely valuable. Some capacity may be underused. Some data centers may be in the right location with the right power contracts. Others may struggle. Some GPUs may stay in high demand. Others may become less valuable as new generations arrive. This is where the AI trade gets more complicated. Investors can no longer just say, AI needs compute, so every compute company wins. That was the easy story. The next stage is harder. Now the question becomes, what kind of compute? At what cost? For which customers? With what utilization rate? And at what margin? That is how bubbles mature. The story moves from excitement to economics. The bigger problem for AI stocks is capital expenditure. Big tech companies have been spending massive amounts of money on AI infrastructure. That spending supports chip companies, data center companies, memory companies, power companies, and cloud providers. But investors are starting to ask, how long can this continue? And more importantly, what return will it generate? If AI spending turns into high-margin revenue, the bull case survives. If AI becomes deeply integrated into ads, software, cloud, enterprise tools, and consumer products, the spending may be justified. But if revenue takes longer to arrive, or if AI services become price competitive, or if companies spend too much before demand is ready, then the market has a problem. Because capital spending is not free. Every dollar spent on data centers must eventually produce a return. That is why Meta's cloud plan matters. It may be smart, it may help monetize unused capacity, but it also reveals the pressure behind the scenes. When companies spend this much on AI infrastructure, investors eventually want proof. Not just excitement, not just demos, not just bigger models. Proof, revenue, margins, utilization, cash flow. That is the next test for AI stocks. And Meta is not the only company thinking this way. SpaceX has already shown how valuable AI compute capacity can become. According to Reuters, Google agreed to pay SpaceX about $920 million per month for AI compute capacity from October 2026 through June 2029. That number is massive. And it sent a clear message to the market. AI compute is not just an internal tool anymore. It can become a business, so Meta's move may be part of a bigger trend. The biggest AI infrastructure builders are starting to ask, if we built this much compute for ourselves, can we also sell it to everyone else? That is where the opportunity is. And that is also where the danger begins. Because once everyone tries to sell compute, pricing power can change. What looked scarce can start looking competitive. And what looked like a premium asset can slowly become a commodity. So who could be hurt if AI compute becomes less scarce? The most vulnerable companies are usually the ones valued mainly on scarcity. AI cloud providers, data center operators with aggressive growth assumptions, hardware suppliers priced for perfect demand, and any company where investors assume capacity will always stay tight. If pricing power weakens, valuation can change quickly. But not everyone loses. The strongest companies may actually benefit. If Meta can sell compute efficiently, it may improve the return on its AI spending. If NVIDIA continues selling the most advanced chips, it can still benefit from AI infrastructure demand. If cloud giants turn AI infrastructure into real customer revenue, their scale can become an advantage. And if lower compute costs make AI cheaper to use, application companies may benefit. That is the balanced view. Overcapacity in one part of the stack can hurt infrastructure margins, but it can also make AI adoption cheaper and faster. This is why investors need to be careful. AI infrastructure is not one trade anymore. It is a value chain. Chips, cloud, data centers, power, models, applications. Each layer has different economics, and each layer will have different winners. So, what should investors watch next? Here is the MarketMind AI framework. Question 1. Is AI compute still scarce, or is supply catching up? Question 2. Are cloud providers earning strong margins, or just renting expensive hardware? Question 3. Are AI customers actually paying enough to justify the infrastructure build-out? Question 4. Is capital spending turning into cash flow? Question 5. If compute prices fall, which companies lose pricing power, and which companies benefit from cheaper AI? That last question is the most important. Because the next phase of the AI trade may not be about who builds the most infrastructure, it may be about who earns the best return on it. So, does Meta's AI cloud plan mean AI infrastructure is already overbuilt? Maybe not. But it does expose the hidden risk in AI stocks. The market used to treat AI compute as permanently scarce. Now, investors are asking a harder question. What if some of that scarcity was temporary? If compute supply catches up, AI stocks will need a new story. Not just more chips, not just more data centers, not just more spending, real returns. That is the line investors should watch. Next week, I'll apply this same framework to one AI infrastructure stock. Should it be NVIDIA, CoreWeave, Oracle, or Broadcom? Comment the ticker below. And I'll break down whether the AI capex boom is still a growth story or already turning into an oversupply problem. This video is for education only. It is not financial advice. We decode the markets. You make smarter decisions. I'm MarketMind AI. See you next time.